Hi there, this video looks at interest rates, which is part of Edexcel 2.5.1 economic influences and follows on from the previous videos. So in the first video I did in this little series on the economy, we defined what the economy was, and we said we can measure the economy by looking at the flow of money that occurs between businesses and households. Now every arrow on this little diagram represents a flow of money. Okay, households consume stuff off businesses, so in exchange for goods and services, households give businesses money. All right, but often we don't think that it might not be immediately apparent that businesses give money back to households, but of course when we think about the fact that people work for businesses, people often own shares in businesses, sometimes businesses rent their premises off households, so there is a flow of money back to households, and this flow of money represents the economy. When we're talking about the economy, what we're really talking about is this flow of money, and when we say the economy is getting bigger, it means this flow of money is increasing. So that's just a very simple model of the economy that doesn't take into account certain flows of money that are important. One of those flows of money in and out of the economy goes to banks. So when people save money, that's a flow of money out of the economy from businesses and households into bank accounts, where businesses and households earn interest for saving money. So that's a flow of money out of the economy. Money can flow back in, of course, when banks lend money to businesses and households, and in return they charge an interest rate for the service of lending money. There's also the government and abroad, but we won't need to worry about those for now. So interest rates are what we're looking at the moment. The technical definition is that they are the reward for saving as a percentage of the sum saved. Okay, so I might get 10% on the £1,000 savings that I've got, or it's the cost of borrowing as a percentage of the sum borrowed. Okay, often that definition is shortened to it's the cost of borrowing, and interest rate is the cost of borrowing and the reward for saving. That's the slightly longer technical definition. And interest rates are used by the Bank of England to influence the economy and predominantly to control inflation, on which I've done an earlier video. But we'll look at how the Bank of England, which is effectively the government's bank, uses interest rates to try and achieve its objective of controlling inflation, which can be very damaging if it gets out of control. So let's say we've got a situation where prices in the economy, where inflation is rising very, very quickly. So what does the Bank of England do? They raise interest rates, and that feeds through to our high street banks, our HSBCs, our Lloyds, our Barclays. All of those banks will increase their interest rates, and that has an impact on the cost of borrowing and the reward for saving. So what happens to the cost of borrowing? Well, if the interest rate goes up, the cost of borrowing goes up. What does that do in the economy? Number one, it's a disincentive to borrow money, to buy new houses, buy cars, put money on credit cards, all of that stuff. So the price of that borrowing goes up, so you're less incentivized to borrow money to do that. Also, debt on existing variable rate debts increase. So an overdraft, a credit card, okay, these are forms of lending in which the interest rate is not fixed and can actually change. Variable rate mortgages. Okay, so what happens is when a bank puts up their interest rate, they charge the consumer higher interest. So people's debt goes up. So all of this contributes towards a disincentive to borrow money and consumers having less money to spend because they need to pay off their debt. Also, the reward for saving goes up, right? So I'm encouraged to put money in my bank. I'm encouraged to take money out of the economy and save it. So you can see where this is going in terms of consumption. Okay, obviously people are going to consume less in this situation because they've got less incentive to borrow, they've got higher debt repayments, and there's more incentive to take my money out of the economy. So what happens to inflation? Well, if it's caused, and we looked at in a previous video that one of the causes of inflation is high demand in the economy for goods and services. Okay, if this inflation is caused by high demand, then this increase in interest rates should help control it. But that's what we call a macroeconomic effect. It affects the whole economy. So how will this affect individual businesses, which you are more likely to need to understand? Well, a rising interest rate. Basically, we've looked at how that is going to lead to lower demand and revenues across the, in their consumers. It's likely a rising interest rate to increase the cost of business debt. So if the business has an overdraft, or if it's got a mortgage with a variable rate repayment, it's going to have to face higher costs. So businesses, when interest rates rise, they generally don't like it because it's lower demand, higher costs, and therefore lower profit. But we could say there might be higher demand for inferior goods because people across the economy have got less income, they're paying off less debt, so their debt. So if you think of your income elasticity of demand, the demand for inferior goods might rise. There might be some opportunities to target savers. So the people who benefit when the interest rate is high tends to be older people who have got pensions and money saved away because they're getting more of a return on their pension. So you could try and target some of your services to them, and also businesses benefit from lower inflationary pressure. It's actually good for the economy as a whole. The business individually might not like it, but it's better for the economy to control inflation. What about falling interest rates? Well, this is generally much better news for an individual business because there's going to be more borrowing to fund big ticket items like, people borrow money to buy houses, cars, refrigerators, sofas, right? Those kind of big items. If there's a falling interest rate, it becomes cheaper to buy them. But, variable rate loans, mortgages, overdrafts, all of those things fall. So people are incentivized to put stuff on credit card. And there's less incentive for consumers to put their money in the bank, right? They get a lower interest rate. So consumers start to think, well, I might as well spend my money. That leads to higher demand and revenues for businesses. The cost of loans and overdrafts goes down for businesses. So this is great news. We're going to get increased demand for normal goods, thinking about income elasticity of demand. Consumers have got higher disposable incomes because they've got effectively less debt. There's going to be lower costs, and therefore businesses tend to grow and expand in a period where there's falling interest rates. And on an individual level, most businesses would prefer to see lower rates of interest.